How do you actually depreciate business assets? And this is an easy tutorial on a complicated problem. And my goal into this conversation is to break things down for you to make it as easy as possible. So stick around till the end of today's conversation.
One in a million, one in a million, one in a million. You know they're coming up to me, cause I'm just the kind of flower that's stinging from the beat, but the rhythm's getting higher. Go, 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 go. One in a million, one in a million, one in a million, one in a million, one in a million.
Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. If you are doing as great as I am, go grab a cup of coffee or tea or vodka. Now let's roll. In today's conversation, I want to talk to you about how to depreciate business assets. And this is actually, we want to have an easy tutorial on a complex problem. Now, if you really think about it, depreciation is not a nice word, right? It sounds like the opposite of appreciate, right? Which is really weird because you'll probably appreciate all the tax savings that come from depreciation, right? Even if you defer all things depreciation to your accountant, you need to understand a little bit about depreciation itself and make sure that you are leveraging depreciation to the maximum. So let's first define the topic. What is depreciation? Well, as you can see on the screen, a very nice picture from our friends at The Balance. So depreciation is actually the process of deducting the total cost of something expensive you bought for your business. So then instead of doing it in all of these things in 1 year, you write off parts of it over time. So when you depreciate assets, you can plan how much money is written off each year, right? Giving you more control over your finances. It's all about liquidity, all about cash flows. So the number of years over which you depreciate something is determined by its useful life, what accountants call useful life. So for example, a laptop is useful for a few years, let's say 5 years. Okay, machinery can be useful for 20 years and whatnot. So for tax depreciation, different assets are sorted into different classes, and each class has its own useful life. So let's say if your business uses a different method of depreciation for your financial statements, you can decide on the asset's useful life based on how long you expect the asset to last in your business. But there are some consequences though. So I'm not going to into details here, but you have deferred tax assets and deferred tax liabilities that account for the difference, for the dichotomy, quote unquote dichotomy, between your tax depreciation and your financial depreciation. That's a topic for another video. So what is an asset? Well, an asset is anything with a dollar value. Okay, the IRS also refers to asset as property. So it can be either tangible or intangible. For example, if you have a patents are intangible assets. Okay, and so a tangible asset can be touched, while an intangible asset cannot be touched. I mean, that just makes sense, okay? So when we talk about office buildings, delivery trucks, computers, those are tangible assets. If you have patent, copyrights, or other intellectual property, those are intangibles, okay? So here is the information you need to calculate depreciation. You need the useful life of the assets, very important. You need to have the salvage value, also called the residual value, okay? And you also need to have the asset cost. Okay, this is the trifecta you need to have to actually depreciate assets. So depreciation is a way for businesses to allocate the cost of fixed assets, including buildings, equipment, machinery, and furniture, to the years the business will use the assets. Now let me just talk a little bit more about assets. What are we talking about? What kind of assets can you depreciate? Well, the IRS has set guidelines for what types of assets you can depreciate. So it needs to meet the following criteria. You own it, you use it in your business or to produce income, you can determine its useful life, and you expect it to last more than 1 year. So this is basically what it is, okay? So you can't use the assets for personal reasons. You can't be driving the car on the weekend. No. You own it, use it for the business exclusively or to produce income that income will be taxed, of course. You can determine the useful life of the asset, and you expect the asset to last more than 1 year. And so when we talk about assets, Here are some common examples of assets depreciated by small businesses. We have vehicles, okay? We have real estate. By the way, real estate, but not land though. I'll talk about that later on. Equipment, office furniture, computers, okay? Now you have an interesting topic that goes along with depreciation, and that's accumulated depreciation. So the cumulative depreciation of an asset up to a single point in its life is called accumulated depreciation. So the carrying value or book value of an asset on a balance sheet is basically a difference between its purchase price and the accumulated depreciation. For example, let's say you bought a car for 20 grand, 20,000, and you have accumulated depreciation on the car, let's say for the last 5 years to $12,000. So the book value of the car will be $8,000. Okay, so you take $20,000, the initial purchase price, minus the $12,000, the accumulated depreciation. Okay, and accumulated depreciation applies to assets that are capitalized. Okay, so when we talk about capitalized assets, we are talking about assets that provide value for more than 1 year. Okay, so this is really important. So accounting rules actually dictate that revenues and expenses are matched in the period in which they are incurred. Okay, so depreciation is the solution for this matching problem for capitalized assets because it does a great thing. It basically allocates a portion of the asset cost in each year of the asset's useful life. Okay, now bottom line is you basically, if you were to comply with the accounting principle of matching, you want to allocate the revenue to the expenses that were incurred to produce that revenue. Okay, remember, you want to depreciate tangible assets except land. Okay, you can depreciate anything else but land. For intangible assets, you don't depreciate them, you amortize them. And this will be the topic for another show. So we talk about amortization for intangible assets, and we talk about depreciation for tangible assets. I want to talk to you now about the depreciation schedule. So one thing that's very important, if you're going to have machinery in your business, you need to maintain a depreciation schedule, because if God forbid you were to be audited, the IRS will want to see your depreciation schedule. And you can see on the screen here, courtesy of our good friends at the Corporate Finance Institute, here is how a depreciation schedule looks like. Okay, it's basically a table that shows how much each of your assets will be depreciated over the years. Okay, so it typically has the following information. You have a description of the assets, date of purchase, the total price you've paid for the asset. That's what we call the initial purchase amount, the expected useful life in years, of course, the depreciation method that you used. I'll go in all the methods pretty soon. The salvage value, also called the residual value. Okay, how much you can sell the asset for once it's past its useful life. Okay, the depreciation amount deductible in the current year, the cumulative depreciation amounts, and the resulting net book value of the assets. So we're talking about total price paid, the initial price, minus any cumulative depreciation. By the way, when I use the terms cumulative depreciation and accumulated depreciation, those two mean the same thing. They are interchangeable. Very important. Okay, and you can set up a depreciation schedule yourself. You can do it in Excel. You can actually do it via accounting software. But the first thing you need to do is you need to think about your revenue. Okay, because your sales revenue is a common driver for both capital expenditures and depreciation expense. Okay, and so after a sales revenue, you want to put your depreciation amounts for the current year. Okay, you can put also your capex, your capital expenditure. You can put that as a percentage of sales. Okay, you can put the fixed recurring amounts and reasonable hard dollars that would be paid for the equipment to be operated. Now, I'm not going into too much details here because this will require another show. And so for the purposes of this conversation, I just want us to give you a general idea of how to depreciate asset. I'm not getting into details about how to create a depreciation schedule. If you guys are interested, if we see enough demand, we see a popular demand for this topic, we'll basically provide a show on that. But it's very straightforward, and you don't have to, if you have no knack for accounting literature, accounting reporting yourself, outsource the whole thing to somebody else on the internet, like Fiverr, Fiverr, Upwork, freelancer.com, or you can hire a local CPA to create actually a depreciation schedule for you. Now let's dig into the more interesting part of today's conversation. I mean, one of our favorite parts. Let's talk about the types of depreciation, right? The whole thing is that there are several types of several ways to depreciate assets for your books or financial statements, okay? But remember, the amount of depreciation expense on your books or financial statements may not be the same as what you deduct for tax purposes. This is what I said earlier. Those differences, those temporary differences, are called. They result in deferred tax assets and deferred tax liabilities. Okay, it's an entire topic in accounting, advanced accounting, that I'm not going to get into today. So let's look at the options available for book and tax depreciation. So we have the single line depreciation. Okay, so this is the most common and simplest way to depreciate a fixed asset. This is this actually splits the value evenly over the useful life of the assets, and this is really good. Okay, and it is consistent. It is the same amount. So this is great for small businesses with simple accounting systems that may not have an accountant or tax advisor to handle their taxes for them. Okay, so the formula is very simple. So you have the asset cost. So this is the purchase amount minus the residual value. This is the salvage value divided by useful life. Okay, so you divide the cost of the asset minus its residual value over the useful life. Very, very simple. As you can see on the screen here, So let's say your party business buys a bounce house for $10,000, and the salvage value is $1,000, and the asset has a useful life of 10 years. Okay, so we plug those numbers into the equation. So the formula, asset cost, you can see on the screen, folks. See on the screen, asset cost minus salvage value divided by useful life. 10,000 minus 500 divided by 10, you have $950. So you will write off $950 from the bounce house's value each year for 10 years. Let's talk about the double declining balance depreciation. So this is a slightly more complicated way to depreciate an asset. So it lets you write off more of an asset's value in the days immediately after you buy it and less later on. Okay, so and this is great for businesses that want to recover more of an asset's value upfront, because the asset loses value quickly in the first few years of ownership. Okay, so the formula is 2 times straight line depreciation rate times the book value at the beginning of the year. So for this approach, in the first year, you will depreciate an asset. You take double the amount you would take under the straight line method. In subsequent years, you will apply that rate of depreciation to the asset's remaining book value rather than its original cost. Okay, so book value here is what, folks? It is the asset's cost minus the amount you have already written off. So the double declining balance method does not take salvage value into account. So I want you to see on the screen here, see on the screen. Okay, that's the first part here. And I want you to see on the screen the second part. So we have the example that is, okay, so this is basically what it is here. Again, I want you to see first screenshot and second screenshot. We've used the same examples that we used before, and this is where the numbers are. All right, let's move on to the third example here. We have sum of the year's digits depreciation. Now, this is another method that lets you actually depreciate more of an asset cost in the early years of its useful life and less in the later years, okay? And this is actually great for a business that wants to recover more of an asset's value upfront, but with a slightly more even distribution than the double declining method that we just talked about earlier. The formula is the remaining lifespan divided by the sum of the year's digit multiplied by the asset cost minus salvage value. I know this sounds like a foreign language to you, but again, it is totally, I'm going to break it down for you. So to calculate sum of the year's depreciation, you add up the digits in the asset value in terms of the useful life that come up with a fraction that will apply to each year of depreciation. So for example, the sum of the year's digit depreciation for an asset with a useful life of 5 years will be 15. Why? Because we have 1 plus 2 plus 3 plus 4 plus 5. When you add everything up, this is 15. And you divide the asset's remaining lifespan by the sum of the year's depreciation. Then you multiply the number by the cost to get your write-off for the year. This might sound like a foreign language to you, but in practice, it's pretty simple. And you will see from, let's see from the example here. So I want you to look on the screen right now. We have 3 slides that I want to share with you, okay? And I want you to really pay attention. So basically, here is the first slide. Okay, and the second slide, and the third slide. So basically, here is the example that you just saw on the screen. So sticking with the bounce houses example, it costs $10,000, has a salvage value of $1,000, right? And will depreciate over a 10-year useful life. Okay, and for the house's 10 years useful life, adding up the digits will look like this: 1 plus 2 plus 3 plus 4 plus 5 plus 6 plus 7 plus 8 plus 9 plus 10. When you add all those things up, it's 55. So the first year you depreciate using some of the year's digits depreciation, your equation will look like this: formula, the remaining lifespan divided by the sum of the year's digit, times asset cost minus salvage value. So that's basically what? That's basically you take 10,000 minus 500. Okay, so it's 500. The salvage value is 500, not 1,000. Okay, so you take 10,000 minus 500 times 10 divided by 55. Okay, and the amount is $1,727. So for your first year, you will write off $1,727. Keep in mind though, each year the bounce house's remaining lifespan is reduced by 1. So in your second year of depreciation, your equation will look like this. So we have a 10,000 minus 500, and this is multiplied by 9 divided by 55. So you will depreciate $1,555. Okay, so in your last year of depreciation, you will write off $173. Okay, I want to talk to you now about the units of production depreciation. This is something that you will really love also to know more about. And so what is this? Basically, this is a simple way to depreciate a piece of equipment based on how much work it does. Okay, so unit of production can refer to either something the equipment creates, like widgets, for example, or to the hours it's in service. Okay, so if you are in manufacturing, this could be good. So this is great for small businesses writing off equipment with a quantifiable, widely accepted output during its lifespan, like based on the manufacturer's specs. Okay, and if you want to take more depreciation in years when they use the asset more and less depreciation when they use the asset less, this is great. Because this method requires tracking the use of the equipment. It is generally only used for high-tech value equipment or machinery. So the formula is the asset cost minus the salvage value divided by the unit produced in useful life. Okay, how does it really work? So using the formula that I just gave you, you figure out the dollar value in depreciation for each unit produced, and by adding up all of the units produced in 1 year, you get the amount to write off things. Okay, so once all of the units have been written off, depreciation of the asset is complete, its useful life is technically over, and you cannot write off any more units. Okay, so here is the example I want you to look on the screen right now. So the first screenshot, the second screenshot, the third screenshot. So basically what you have just seen on the screen, it means that, let's just break it down. Since hours can count as units, we want to stick with the bounce house example. Remember, the bounce house costs $10,000 and has a salvage value of 500, right? So its book value is 9,500. So let's say that according to the manufacturer, the bounce house can be used a total of 100,000 hours before its useful life is over. So to get the depreciation cost of each hour, we divide the book value over the units of production expected from the asset. So $9,500 divided by $100,000, that's 0.095, right? So that's an hourly depreciation of $0.095. So in the first year of use, the bounce house is bounced upon for a total of 12,000 hours. So for our equation will look like this: $12,000 times 0.095, that's 1140, 1,440, 1,140. So we can write it off this amount, we can write this amount off as depreciation for the first year. So that number will change each year. Remember, you can write off a total of $9,500 or $100,000, okay? And you also have the modified accelerated cost recovery system, or we call the MAKERS. And this is the depreciation method generally required on a U.S. tax return. So under MAKERS, assets are assigned to a specific asset class, and that class determines the asset's useful life, okay? Double declining balance and some of the year's digit methods are examples of MAKERS depreciation, and this is really important, okay? And if you are interested in the topic, you can actually go to IRS publication 945 Appendix B, okay? And so I'm showing you right now on the screen, we have a summary of the MAKERS table. So the first screenshot. And the second screenshot. So here you have it, okay? So who is it for? Any business or rental property owner that claims depreciation expense on a U.S. federal income tax return, okay? And calculating MAKERS depreciation can be complicated. So please reach out to a local CPA or somebody who knows what they're doing, or use accounting software, tax software, to handle the calculations for you. Let's do a little comparison here, and I really want to dig a little deeper here. So to help you actually get a sense of the depreciation rates for each method and how they compare, let's use the bounce house and create a 10-year depreciation schedule. Okay, remember, as a reminder, it is a $10,000 asset with a $500 residual value, okay? So the recovery period is 10 years, and you can expect to get 100,000 hours of use out of it, okay? So for the sake of this example, the number of hours used each year under the units of production is randomized, okay? We just want to make things a little easy, okay? So you can see, I want you to see right now on the screen what the final numbers look like. So we are comparing, again, we are comparing straight line to double declining, to some of the year's digit, to unit of production. You can see for each year, for year 1 all the way to year 10, what the depreciation amount is. And you can see very clearly that the amount is larger in some of the year's digit and double declining in the very first few years, right? Whereas for straight line and units of production, we do have a fairly, even though the number of hours was randomized, we still have a fairly even number of fairly amount of depreciation, okay? So I want you to pay attention. So you have to think about which method works for you, okay? And once you have that, once you have the depreciation amount, you need to put that in your books, right? But you don't have, again, if you're not an accountant, don't pay attention, but I just wanted to explain to you for the sake of explanation. So if you want to record the first year of depreciation on the bounce house using the straight line depreciation method, here is how you would record it as a journal entry. I want you to see on the screen here. So you would actually debit depreciation expense and credit accumulated depreciation. So an expense in accounting, for those of you who have a little bit of accounting knowledge, an expense, you debit it to increase it, right? If you want to increase an expense, you have to debit it. And accumulated depreciation, you're crediting it. Now, this is not in accounting, we don't call this a credit account. It is a contra asset account. In other words, accumulated depreciation reduces the value of an asset. So it is a contra asset account. So you basically, on the balance sheet, you would see accumulated depreciation on the asset side. You will not see it on the liability side. You basically will see the asset being recorded at purchase price, and you will see less accumulated depreciation, and that will give you the book value of the asset. So you take purchase price minus accumulated depreciation to get book value. But again, this is for folks who are studying for the CPA exam, but for you as a business owner, I'm just giving you the broad explanation here. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. I'm still having a conversation with you about how to depreciate business assets. Now, I want to talk about rental properties, okay? How do you actually depreciate rental properties? Now, if your business makes money from rental property, there are a few factors you need to take into account before depreciating its value, right? So, one thing right off the bat, and I've said this before, you want to depreciate buildings, not land. Very important. You are allowed to depreciate the value of a building you have purchased, but the value of the land it is owned cannot be written off. Often the challenge is knowing how much you paid for each. Okay, if you can determine what you paid for the land versus what you paid for the building, you can simply depreciate the building portion of your purchase price. But if this information is not readily available, you can estimate the percentage that went toward the land versus the amount that went toward the building by looking at the taxable value. Okay, so for example, let's say that the assessed real estate tax value for your property is $100,000. The assessed value of the house is $75,000, and the value of the land in this case is 25,000, right? So 75% of your property's value is the house. So if you paid, let's say, $120,000 for the property, then 75% of the $120,000 is $90,000. So that's the depreciable value of the house. Okay. Now there are extra fees. So when you buy property, right, many fees get lumped into the purchase price. You can expense some of this cost in the year you bought the property, while others have to be included in the value of the property, and those have to be depreciated. Okay. So let me just break it down for you. So here are the costs that can be deducted in the year of purchase. You have mortgage, interest, and points, real estate taxes. So those are not capitalized, those are expensed. Okay, real estate taxes and mortgage interest and points are expensed. You write them off. Now, the cost that must be added to the value of your property, in other words, capitalized, and of course, subsequently depreciated. Those include the legal fees, surveys, transfer taxes, title insurance, amounts the seller owes which you have agreed to pay, such as back taxes or interest and sales commissions. So it's always a great idea, folks. It's always a great idea to consult with your accountant before you decide which fees to lump in the cost of the property. Okay. And one thing I want to say here is that if we're talking about improving the property before renting it, you have to think about taxes too, because in between the time you take ownership of a rental property and the time you start renting the property out, you may make some upgrades, right? Some of them can be added to the depreciable value of the property. So those include features that add value to the property and are expected to last longer than a year. So examples include a new furnace, new windows, or new flooring. So anything that actually will last more than a year can be capitalized. Okay. On the other hand, expenses to maintain the property are only deductible while the property is being rented out or actively being advertised for rent. So this includes things like routine cleaning and maintenance expenses and repairs that can keep the property in usable condition. Those you do not depreciate, you expense. Before we close today's tutorial, I want to talk to you about section 1250. And this is quintessential if you really want to understand what we talk about in terms of depreciating business assets. So Section 1250 is only relevant if you depreciate the value of a rental property using an accelerated method and then sell the property at a profit. Okay, so this is important. So without Section 1250, strategic house flippers could buy a property, quickly write off a portion of it, and then sell it for a profit without giving the IRS their fair share. Okay, so the bottom line here is that the authorities have put in place Section 1250 to protect against this kind of tax avoidance. Okay, so if you use an accelerated depreciation method, then sell the property at a profit, the IRS makes an adjustment. So they take the amount you have written off using the accelerated depreciation method, and they compare it to the straight line method and treat the difference as taxable income. In other words, it may increase your tax bill in the year of sale. Okay, so next time you think about accelerated depreciation, be very careful here. Okay, the bottom line is if you're paying rental property and plan on selling it within a few years, you may want to talk to your CPA or accountant or EA, enrolled agent, before making any big decisions. Okay, so How do you file depreciation? Well, to claim depreciation expense on your tax return, you need to file Form 4562. Okay, 4562. We have actually covered this form on another show. So if you're interested, either leave us a comment or you can just go and browse our catalog of tax videos. We do have a complete video on a form 4562. Okay, and one thing I want to say here is you also want to think about when we talk about 1250. Obviously, you have a concept called unrecaptured Section 1250 gain. So basically, the unrecaptured Section 1250 gain is the gain you earn after selling a Section 1231 asset for which you claimed depreciation tax in previous years. Okay. Now, the thing here is that this will be a long conversation here, and but I'm not going to go into too much detail because it goes beyond the province of today's show. But one thing I just want to say is that Section 1250 tax the gain you get from selling the property as unrecaptured when the sales price exceeds your initial cost basis in the asset, which is the total of what you paid for it. You paid for the asset and spend on maintaining it. So it adjusts the basis for adding back the depreciation you claimed. Remember, the whole idea here is that the IRS wants to make sure that you pay your fair share, right? And if your fair share of taxes. And if you want to, there are ways that you need to report unrecaptured Section 1250 gains. Okay, you can do so on Form 4797. Then you can transfer that total to Schedule D. Okay, and but the bottom line here is that if we see a lot of, if we see growing demand, growing interest in the topic, please let us know. You just leave us comments and leave us some comments under this video, and if we see a lot of people are interested, we will do an entire video on unrecaptured Section 1250, and we can also do a video on Section 1250 itself. Okay, this is totally possible. Thank you so much for your attention. I really appreciate it. I was talking to you today about how to depreciate business assets, and this was an easy tutorial on a complicated problem. So we defined the topic, the assets that you can depreciate, the schedule, the depreciation schedule, the types of a depreciation, the comparison, how you depreciate rental property, and we spoke a little bit about Section 1250. Thank you so much for your attention. I really appreciate it. I'll see you next time. But until then, remember, stay marvelous.